All right, can everybody hear me? All right, good. So my name is Ben Rohn. I am thrilled to be back here again at Startup Boston Week. Some of you might have caught my presentation yesterday on working with lawyers. I've now been presenting at Startup Boston Week for, I think, 5 or 6 years now, and it is just a fantastic conference, and it just gets better every year. So really happy to be back here. Quick show of hands, how many of you actually are currently running a company, like are founders of a company? Okay, great. So we have a lot of people in the room that are actually that are on this path already. An exit may not be the top of mind at the time you go to raise capital, but it is something that you should think about, because when you're raising money from, because who you raise money from and the terms of the financing can have a material impact on how much control you have over an ultimate exit, over the timing of the exit, over how much of the exit proceeds you're actually going to collect. My goal for this session is to help you understand how financings can impact an exit, so you're better prepared to negotiate financing terms that will leave you in the best possible position when you do exit. So quick note about me, I'm a partner at the law firm of Brown Rudnick here in Boston. I'm in the corporate group and part of the emerging growth company and venture capital practice. I've been practicing law for 20 years now. It hurts me to say that, but I've been practicing law for 20 years, and my practice focuses on representing early stage technology companies or technology companies from inception through exit. For most of my clients, I serve as an outside general counsel. That means that I will do work within my area of expertise, which is company formation, fundraising, mergers and acquisitions, but with respect to other things that the company needs, like intellectual property, labor and employment, taxes, I will coordinate with people either within my firm, or another firm. Since I am a lawyer and this is a presentation, there's a disclaimer. The disclaimer basically says that the information in the presentation is current as of today, and I'm not obligated to update it once it goes out into the world. So the path from inception to exit, or inception to financing and financing to exit, is never a straight line. And there are a lot of factors that will impact a company's exit opportunities. Jason Lemkin, who was I think he was a multi-time founder who is now a VC, explains this in terms of local maxims, and this is his chart. He says basically that a company in a hot space, in this, take for example right now, artificial intelligence, right, might get an opportunity to sell in the high 8 figures, so 10 to 100 million, somewhere in there, once it has some initial traction. But pricing for these kinds of acquisitions isn't based on some multiple of revenue. It's basically the acquirer pricing the deal based on the target's traction, how fast is it growing, and some strategic need that it fills for the acquirer. If your company isn't in that space, or if it doesn't fill a strategic need for a particular acquirer, or if you just, for whatever reason, don't come across the right acquirer, then it's difficult to get a meaningful exit or meaningful multiple on an exit. So say 10x or more on your revenue until you've reached about $10 million of revenue. At that point, you're gonna have a choice. You will have raised some money. You could keep raising money. You've got meaningful revenue. You can keep going, or you can try to sell at that stage. If you keep raising money at that point, you're quickly going to reach a point where you've priced yourself out of all but the largest exits or a possible IPO. For example, if you raise a $30 million round at a $200 million valuation, right, the investors in that round are likely going to be looking for you to exit at a valuation in excess of $1 billion, which would give them a 5x multiple on their money. That's going to be very hard to find from all but the largest possible acquirers. To understand your company's path to a successful exit, you need to understand what a successful exit actually looks like, so you can jump the opportunity if one arises. While initial public offerings and large acquisitions grab most of the headlines, they are the exception rather than the rule. So this chart shows the relative frequency of 3 common types of exits: an acquisition, an initial public offering, and a buyout. A buyout, for those of you who may not be familiar, is typically when a private equity fund comes in and they acquire a majority stake in the company in exchange for usually fairly little cash. They'll put some money in, but most of it isn't going to go out to the existing investors or the stockholders. The existing investors and stockholders are typically going to be crammed down to a small percentage of the company, oftentimes less than 20%, sometimes less than 10%. There'll be an incentive pool set up for management that continues on, but the private equity investors are taking the majority of the interest in the company going forward. It's sort of a crammed down recapitalization for the company. And it happens a lot in times like now, where you can find good companies out there that just can't raise capital. So as you can see, according to this data from PitchBook, about 70 to 80% of all exits for VC-backed companies are acquisitions. IPOs, on the other hand, make up a small portion, maybe 5 to 15% of exits, even in hot IPO markets like 2021, and much less in IPO markets that are in cold IPO markets like the one we're in now. This next chart breaks down acquisitions over the same period of time based on the number of rounds of capital that the company raised prior to being acquired. This data shows that nearly 80% of acquisitions occur before the company raises a Series C round of financing. While some of these early stage deals are blockbuster acquisitions at unicorn valuations, the vast, vast majority of them are going to be smaller acquisitions, and a fair number of them are going to be acqui-hires, which is basically where the acquirer is spending a little bit of money primarily to acquire the team. I want to impress on everyone that a successful exit is not limited to an IPO or an acquisition in a unicorn valuation. For your company, a successful exit might be an 8-figure acquisition before you raise a Series A, or a low 9-figure acquisition once the business starts to scale, or something entirely different from that. That may not be the exit you dreamed of when you were starting your company, but you have to play the hand you're dealt. And right now, this is what the hand looks like. So a common rule of thumb is that it takes 7 to 10 years to go from inception to exit. But how long it takes before you will have the opportunity to exit will depend on a lot of external factors, including the macroeconomy, over which you will have no control at all. This chart shows the number of acquisitions of VC-backed startups over the last 10 years. As you can see, timing has a tremendous impact on exit opportunities. And right now is a really bad time to be trying to exit. When you're starting your company, you have no idea what's coming down the road in a year, much less 7 to 10 years. When the companies that started in 2015 were starting their companies, it was a phenomenal time and the trends were just going up. But who the heck knew when they were getting ready to exit, many of them, that we'd be in sort of an apocalyptic winter for startup exits. I doubt much of this information is news to most of you. If you've been an entrepreneur for more than about 5 minutes, you know it is hard and the path is long. But it is helpful to remember that a financing is a means to an end, not an end itself. The goal of a financing is not to raise capital. It is to put you in the best position possible to achieve a good exit. Capital is absolutely an important part of that, but it is only one of the things that you need to think about. There are a number of financing factors that will impact an ultimate exit, and in particular, an acquisition. In the interest of time, I'm going to talk about a few of those. Can't cover everything in this 45-minute period. The first factor, and the one that impacts all the other factors, is the type of investor. Where does the money come from? Different investors have different time horizons, return expectations, and network connections. Venture capitalists typically invest out of funds that have a 10-year life cycle. And while there's usually some ability to extend that term if they need more time to liquidate some of their investments, they generally want to exit in 3 to 7 years. Since VCs are pure investors, meaning they're not strategic investors, they're not economic, they don't have their own operating companies. They're most concerned about the size of the exit and not the type of exit. They want the best economic outcome, whether that's an IPO or an acquisition, and they don't tend to care who the acquirer is if it's an acquisition. They are, however, very concerned about making sure they have a hand in any sale process and will insist on terms that give them leverage to compel an exit under certain circumstances. If the company is simply going along and the founders, for whatever reason, are refusing to sell, even though they have the opportunity, refusing to exit. By contrast, corporate venture capitalists and other strategic investors are often already in or planning to get into the same industry that your company is in, may not have the same time horizon as a venture capitalist. They may not care if the company exits in 5 years or 10 years, but they will typically have a much more restrictive view on what is an acceptable exit to them. A corporate venture capitalist often will invest in a company with the expectation that it will eventually acquire the company. But at the very least, it wants the ability to prevent an acquisition by one of its competitors. So it's going to try to negotiate a veto over third parties or a right of a first refusal or a right of first negotiation if the company initiates a sale process. Angels and angel groups don't have the same types of concerns about, as VCs and CVCs. They're not necessarily as restricted on timing. They don't necessarily care who's acquiring the company, but they also want to make sure their money isn't tied up indefinitely. So even at the angel and angel group level, you can get terms in a financing that can require you to return the money to the investors if you don't exit within a period of time, plus some return on that investment. Government actors, the U.S. government, state governments, also provide funds to startup in the form of grants and loans, sometimes direct investments. Governments generally do not seek to exercise any control over day-to-day affairs. They offer favorable economic terms, and they have an absolutely infinite time horizon. But they may insist on other terms, like a veto on the sale of a company to certain third parties, or on the transfer of key assets to third parties. For example, if you take a grant from the Department of Defense, the Department of Defense is going to prohibit you from selling to most likely non-US companies or companies controlled by non-US persons, right? Similarly, they're going to prohibit the transfer of other technology, or some of your technology, to those third parties. And they may have other conditions that they impose on you in the interest of national security. So in any of these circumstances, you have to be aware of what perspective your investors are bringing and what kind of things and how that is going to impact the potential sale in the future. Now, the most obvious financing factor that impacts an ultimate exit is how much the founders are going to be diluted. This is initially just a function of the valuation at which you raise capital and the amount of capital you raise. But There are two other terms that can have a significant impact on dilution going forward. The first is what's called an anti-dilution provision. Most corporate venture capitalists and venture capitalists structure their investments as the purchase of stock in the company that has special rights and preferences. And this is typically called preferred stock. And preferred stock is different from common stock, which is the stock that's owned by the founders and also issued to employees, advisors, and others in exchange for services. Preferred stock typically converts to common stock at a 1-to-1 ratio when it's initially issued. And that conversion impacts a lot of things, including how preferred stock votes. So preferred stock will initially vote 1 share preferred stock is equal to 1 share common stock, 1-to-1. But that ratio is subject to adjustment under certain circumstances, and particularly if the company goes out and raises additional capital at a lower valuation than the one at which the investors put their money in at. The adjustment is typically based on a weighted average formula that takes into account the difference between the valuation of the earlier round and the down round, the new round, as well as the amount of money being raised in the down round. The specific parameters of that calculation will impact the additional dilution that you as a founder will suffer if the company later raises money at a lower valuation. The other term impacting dilution is the option pool. When evaluating terms of a financing, check to see if the option pool is treated as part of the pre-money valuation or post-money valuation. If it's part of the pre-money valuation, you need to understand that you're already being diluted by the option pool, even if none of the options out of the pool are ever issued, because that valuation is taken into account in the valuation of the company that you're issuing new shares at. Another pair of factors that impact how proceeds will be shared in an exit are the liquidation preference and dividend provisions. The liquidation preference determines what multiple of its investment investors are entitled to get back when the company is sold before any of those proceeds go to the founders or other common stockholders. This is called the investor's preference. The liquidation preference also determines whether the investors get that preference back plus there's pro rata portion based on their ownership interest of the rest of the proceeds that are available once the preference is paid out, or if they get either of the two. In the vast majority of early stage financings, the investor's preference is equal to the amount initially invested, and the investors are not entitled to receive their preference and their proportionate share of the additional proceeds. They get one or the other, whichever's greater. This is usually referred to as a 1x non-participating preferred stock. However, in a more investor-friendly and fundraising environment, such as the one we're in now, those terms can sometimes change. We'll talk more about that in a second. Dividend provisions come in two flavors: cumulative and non-cumulative dividends. Non-cumulative dividends are only paid out when the company's board of directors actually declares the dividend, which rarely ever happens because companies these stages don't have any spare money to be issuing out money to their stockholders as a dividend. Cumulative dividends, on the other hand, give holders the right to dividends that accrue at a specified rate over time. The potential impact of cumulative dividends is most significant for a company if it's eventually sold for a modest amount that is neither a failure nor a home run. In other words, the exact exit scenario of most companies. If the company is wildly successful, the amount of money paid out in dividends relative to the overall proceeds doesn't matter. If the company fails, then there's no money to pay the dividends anyway. Between those two extremes, however, dividends can take a fair amount of bite out of the eventual payout for the founders. Not surprisingly, in a more investor-friendly environment, the percentage of transactions containing cumulative dividends tends to rise. So this chart shows changes in the percentage of deals tracked by Carta, which is a cap table management software, that include cumulative dividends, a liquidation preference greater than 1x, or participating preferred stock from 2019 through 2022. You can see that as the fundraising environment began to sour in 2022, the percentage of deals containing cumulative dividends or liquidation preferences increased, which is not surprising. Now, this is across all stages, so some of these are later stage deals, but you can definitely see an upswing in more investor favorable terms. Now, at first glance, it might seem a little surprising that the percentage of deals with participating preferred stock actually stayed relatively steady over that period. The reason for this may be that participation only really matters if the proceeds from a sale are great enough to pay both the preference and then something else. So if investors are expecting more middle of the road exits over the next few years, it stands to reason that in a negotiation, they'd be more interested in cumulative dividends and a higher liquidation preference multiple than they would be in an actual participation. So up to this point, we've been talking about the impact on the economics of an exit. But there are also a number of terms, or the terms that impact the economics of an exit. But there are also a number of terms that you want to watch out for that impact the exit process. And in particular, who controls whether and when the company is sold. Two ways the investors can exert control on an exit are through representation on the company's board and special voting rights that give them a veto over major transactions like a sale. The composition of the company's board after a financing can actually be the subject of a significant amount of negotiation. But typically, the board is going to consist of between 3 and 5 directors. And usually that includes the CEO, 1 or 2 directors that are designated by the founders, 1 or 2 directors that are designated by the investors, and sometimes an independent director. Now, in early stage financings, the CEO is usually one of the founders. So the board at that stage is typically fairly balanced. And sometimes the founders actually have a little bit of extra sway on the board. But that can change over time. And in particular, it can change if the CEO, if basically the founder is the CEO, ceases to be the CEO, which is not an uncommon thing to happen once a company gets past a round or 2 of financing. At that point, the investors may end up with more control over the board because, for example, the new CEO may be somebody that they brought in and who's more aligned with their view than with the founders. In evaluating the terms of a potential financing, you want to pay attention to the composition of the board and also how that composition can change over time. Who has the right to elect directors? Who has the right to remove the directors? Who has the right to elect or appoint and remove the CEO? Is that something completely with the investors' purview, or do the founders retain some control over it? Another way investors exert control over an exit process is by retaining a veto over a sale. This is a standard term in a Series A financing, but not quite as common in earlier financings. So at a Series Seed stage, it may still be possible for you to negotiate away this kind of provision, but it is still very common for investors to want some sort of say in an exit. At the earlier stages, you may be able to limit that veto based on the amount of the exit. In other words, you may have something that says, look, you get a veto over the exit unless we sell for at least X dollars. But once you get a little further along, certainly at the stage of a Series A, it's pretty typical for the investors to want an outright veto on an exit. So in that case, what you're trying to do is make sure that the threshold for that exit is as low as possible. Ideally, a simple majority of the investors' shares. and you prefer that the vote doesn't require any particular investor to reach that threshold. Usually the lead investors will insist on a veto over that. It's an absolutely standard term and it's hard to fight, but you should at least understand that dynamic when you're going out and raising capital. On the flip side, another common term in a financing that can have a tremendous impact on an eventual exit is a drag-along provision. The drag-along requires stockholders to cooperate with the sale of the business, the sale of the company, if the sale is approved by a subset of the stockholders, and in some cases by the company's board of directors. Now, understand that typically an exit of a company without any external contractual requirements, an exit of a company is going to require usually board approval and a majority of the stockholders. A drag-along changes that dynamics for certain types of acquisitions. It says a minority of the stockholders can actually force the majority to go along with that kind of exit. Now, there are ways in which that can actually be beneficial to founders, because if you're in a situation where you have a bunch of minority stockholders, maybe former employees that you have to wrangle into an acquisition, you don't want somebody sort of trying to hold things up. But the devil's in the details. Who controls that drag along? If the investors control the drag along, they may have the ability to force a sale of the company on the founders, even though they own a minority interest in the business. For that reason, it's very important that you understand the mechanics of the drag along and try to negotiate a blocking right for the common stockholders, or at least the founders at the earlier stages. The investors are almost inevitably not going to allow themselves to be dragged along. In other words, they're going to want a veto over a drag along. But that doesn't mean that the founders can't have one as well, at least so long as they continue to work for the company. So before we get to questions, I want to just throw out a couple of things. Before we get to your questions, I want to talk about a few questions that you may want to try to answer in the process of raising capital to help ensure that the financing will get you closer to your goals. First, what are the goals for your business? Thinking about the desired outcome will help you determine what the best fundraising strategy is, and may actually also help you narrow your list of potential investors. What is your exit strategy? It is important to be aspirational, but realistic. Your exit strategy should align with your goals for your business. Who are the potential acquirers? Even if your goal is to IPO, to take the company public, you should still make a list of potential investors. It will help you refine your business plan and might actually also help you refine your list of investors. It'll also help you when you're presenting to investors to show them you thought about an eventual exit. Which investors best align with your goals? Even in a Series Seed financing or Series A financing, it's beneficial to have investors that can help facilitate that exit that you're looking for. Oftentimes that's through industry connections. How do you align your goals with those of your investors? One of the key issues here that can be a sticking point is valuation. There's obviously a tension because you want a valuation that's higher because it means less dilution for you. But at the same time, if you're raising at a higher valuation, that's going to influence your investors' view of what kind of exit is needed to get them to the result that they need. So setting a higher valuation may make it harder for you and your investor to come to an agreement on what constitutes a good exit in the future. How much do you need to raise? Do you have a clear strategic plan for what you're going to do with that capital and how it's going to be utilized to maximize growth and facilitate that successful exit in the future? If you don't, you might be trying to raise too much money. finally, how does this round affect your future fundraising possibilities? Are the investors in this round able to continue to fund the company for the long haul? Are they likely to be committed to that? Will they make it easier or harder to bring in new investors in the future? All these things can have an impact on how you view answering all these questions will help you basically get a better perspective on your fundraising and hopefully on an eventual successful exit. So that's the end of the formal presentation. I wanted to leave some time for questions. And I don't know if we have some online, but anybody in the room? Yeah. Oh, sorry, I think you got to wait for the mic if you're in the room.
Hello. Oh, wow. Thank you. This is very insightful. I appreciate it. I just had a quick question about early stage financing. We've been working with a few angel groups that do preferred price rounds as that first round versus safe agreements through VCs that we've seen. Just wondering if you could talk to kind of both sides as an early stage founder, like, what are the red flags on each side and what are the green flags?
In terms of which one is better?
Yeah, kind of. Pretty much like what's good and what's bad.
Yeah. So there's, I'm going to give you the lawyer answer. It depends. So the problem with priced rounds is they're expensive. More terms, more variables, more paperwork, more time, more legal fees. However, they do set a line in the sand as to the valuation, which some investor groups in particular like. There is no right answer to it. Ultimately, the problem is if you're raising less than about $1 million, it is hard to do a priced round cost effectively, right? Ideally, you want, legal fees I don't have the numbers in this presentation, but legal fees in a Series seed financing are typically going to be between $15,000 to $20,000, right? You might be able to get it down to 10 in some instances. More likely, it's going to creep up to 25. When you're doing that, raising $500,000 just isn't. It's not a cost-effective way of doing it. Raising $1 million, considerably more so. Remember, the amount of legal fees is not going to be dependent on how much capital you're raising. It's just going to be dependent on how much time it takes me to do the work, or one of my colleagues or your lawyer. So that's the problem with early stage, with doing a price round at the early stages. If you're raising more than $1 million, especially if you can do it efficiently, then I don't have a problem with it. And there can be some advantages. My advice to you, and I have a whole nother presentation on raising capital effectively, but my advice to you is good term sheet. Try to flesh out the terms as much as possible at the term sheet stage before you get into documents. Keep it simple. Don't try to over negotiate things, and get a strong lead investor. Because if you've got a lead that will bring everybody else along, that makes life much easier. But if you're trying to herd cats, it's really, really expensive way to raise capital. So I have nothing against price rounds at that stage, but you have to watch how much it's going to cost you. Does that answer the question? Other questions?
Ben, you want to take a shot at the one online?
All right. Let's see here. They go from, let's see, top. Okay.
So basically, we've got somebody who is a venture capitalist, and they're saying it's a tough environment for venture capitalists, and they've had difficulty raising subsequent funds with more LPs demanding liquidity. When are VC funds okay with exiting their position in an earlier stage of startup? Again, Series A or B.
I'm trying to raise it. Okay. Yeah, I'm trying to. I'm reading. With more LPs demanding liquidity. So, are more VCs open to earlier exits? I mean, I think the short answer is yes, they're open to earlier exits because, frankly, at this stage, if they can jettison some of their some of the funds that, or some of the companies, the portfolio companies that they don't think are going to outperform and get some return on that capital, then yeah, I think they are absolutely willing to do that. But the problem is who's the buyer, right? It's not a question of are they willing to sell, it's a question of who's buying. There has been more activity in the market around search funds, as well as other investors that are looking to basically pick up companies at lower valuations than they would have been able to before, that still have promising technology or a good team. And we are seeing that in the M&A market, but it's not the same volume that that we were seeing a couple of years ago.
Ben, I've got a question for you.
Yeah.
So you've got a lot of perspective, and this was a wonderful presentation. What you've seen so far with the seed companies, are you seeing more go an angel route, crowdfunding route, or venture route at this point?
Whatever's available in this kind of market. The type of fundraising, crowdfunding is tricky because crowdfunding is something that only really makes sense for certain types of companies. It is hard to raise a crowdfunding round if you are a medical device company, or if you are a life sciences company, or if you are in just about anything that isn't consumer facing, right? Because the potential investors in your business are in a crowdfunding financing are most likely to be your potential customers. So I'd sort of put crowdfunding in a separate box. As far as angels versus VCs, everything's slow. I think that I think people are sort of looking for whatever they can get. Honestly, I haven't noticed a preference. It is really in the last year or so, it's been slow enough that they're looking for whatever money is available. And it is, look, I'll be honest, it's been bad out there for the last year, but particularly since SVB, since the incident with SVB, and I know they're right outside the door. Since the incident with SVB that happened in March. So for what it's worth, I'd say don't quote me on this, but this is on video. It may be getting a little bit better. There is sort of talk that people are coming back from the summer. They've reset expectations, and people are looking to do deals. So we'll see if that actually happens in Q4. But at least investors, including LPs, are feeling a little more comfortable about the fact that the economy isn't just going to crash. And we've started to see a few IPOs, including a few this past week, that have gone off all right. And so that inevitably leads to a little more investor comfort with the market.
Great. I've got another one for you.
Go for it.
So when somebody's looking, because we're talking about ultimately the exit, at what stage should companies be looking at those potential acquirers down the line and start building those relationships?
I don't think it's ever too early to start the relationship building. Same thing when you're raising capital. It's never too early to start meeting potential investors. But the serious conversations aren't going to happen until later on. Now, as going back to the chart that I showed at the beginning, an acquisition at the very, very early stages is going to be not quite serendipity, but it's not something you plan for. You get noticed for whatever reason by a potential acquirer. They approach you about it, and you get a deal done. Once you get to the later stages, once you've raised a few rounds of capital and you're sort of in that $10 million plus ARR, then if you are interested in acquisition, you can start reaching out through your investors, through other third parties. It might even be customers that you have at that time. So, but I think that you have to make the deliberate decision. And really at that stage, the board has to make the deliberate decision that it's interested in an exit.
Great answer. Anyone in the room? Otherwise, we're going to go back to online. Biplap Malau asks, can you reject an offer after signing an MOU if the fund does not get transferred on time?
So I guess I'm a little confused by that because I'm not, an MOU is a memorandum of understanding, a term sheet, a letter of intent. Those are preliminary agreements that eventually lead to a definitive deal. There's not usually any money that is transferred at the time of an MOU being signed, so I'm not quite sure what that would have, what that refers to.
If the VC fails to deliver.
Yeah, I think you may be talking about financings instead of acquisitions. Again, there's rarely ever any money actually transferred at the time a term sheet or an MOU is signed. So I'm not really sure how to answer that question. Sorry.
You had a slide that talked about the like 1x non-preferred stock,
Yeah.
and then the like the breakdown of the three types. Can you explain those one more time? What those three categories are?
The three categories of preferred
You had a slide. It had like dates on the timeline, and it had like the same time three times across, and then it had
this.
Yeah. Can you explain this one more time? About like what the overarching categories are? I understand what the numbers are doing down below.
Okay,
But I don't
so
understand
the three categories are the three terms that I talked about on the slide before this, which were basically cumulative versus non-cumulative dividends, a preferred stock preference that's more than 1x, and participating preferred. So cumulative dividends are dividends that accrue over time. So for example, it's sort of like interest. So in preferred stock, the equivalent of interest on debt for preferred stock is an accruing dividend. So you might have a deal where the investors ask for, say, a 5% accruing dividend. That means that if they put $1 million in, that $1 million is accruing a 5% dividend every year. Okay? And at the time of an exit, that money has to be paid out. The 1x liquidation preference is just means that the investors get their money back at the time of an exit. So a greater than 1x liquidation preference means that they're getting more back before the rest of the stockholders get anything on their money. So imagine a 2x liquidation preference. If the investor put in $1 million, it means that they would be entitled to $2 million of proceeds before any of the other proceeds go to the rest of the stockholders. A participating preferred means that they get that preference, whatever it is, and then they share with the rest of the investors. So let's say they put in $1 million and they bought 30% of the company. In a participating preferred scenario, they get their $1 million back plus 30% of what's left over. In a non-participating preferred scenario, they get their $1 million back or 30% of of the total amount of the round. Okay. So obviously all these terms are investor favorable, right? And that's why it's not surprising that we see cumulative dividends and larger liquidation preferences increasing in more investor-friendly environments. And as I mentioned earlier, it's a little bit of a paradox that it initially seems like a little bit of a paradox that participating preferred wouldn't be more common, but it's still staying steady. And I think my guess is that has to do with the fact that if you're negotiating a down round with one of your portfolio companies, the greater liquidation preference and the cumulative dividend are likely to be more impactful at the time of an exit than a participating preferred stock.
Thank you.
Yeah. Was there somebody over there who had a question? Yeah, shoot.
That drives the size of the dividend? It's often one of those things that's sort of buried in the note or the documents that no one really thinks about. But like, what drives that number?
My job to think about it. That's yeah. I mean, market is the short answer. The dividend is typically around 5 to 7%. That's sort of the general range. I will say that most of the time in early stages, we don't see an accruing dividend or a cumulative dividend. But it is more common at later stages. And it can get more common, particularly as if the exit event seems to be a little further in the future, because that dividend really can add up, especially when you have larger rounds.
But the actual 5%, 7%.
The market. Yeah. It's just the market. And I mean, the short answer is the alternative investment possibilities, right? Like, what else can you do with that money? So interest rates are going to have something to do with it. Negotiating leverage is going to have something to do with it. You know, at a time where, and frankly, the other terms, right? So there may be a deal where, an investor favorable deal where the investor sort of, where you end up trading off between things like higher liquidation preference versus a cumulative dividend, or you know, participating preferred, or some of the other economic factors, even valuation, right? The investors may say, look, I'll give you the higher valuation you want, but in return for that, I want a dividend over time. So it's just negotiation. The actual rate is typically more, again, based on the larger economic factors, but whether there is one or not is going to depend on negotiation of other terms. Any other questions from the audience or online? Okay. I think we're about at time.
Yes, I think everyone's still waking up a little bit, but that was really helpful, useful, instructive.
Thank you very much.
Really
everybody.
appreciate that. Great information.